What if every empire's final trick was the same? A quiet, bureaucratic ritual disguised as salvation, a printer that promised prosperity and delivered collapse. What if the fall of Rome, the ruin of Weimar, and the slow unraveling of modern superpowers were not accidents of fate, but the inevitable outcome of the same financial blueprint? Where are you watching from? New York, Lagos, Mumbai, or Casablanca? Drop the city in the comments and subscribe for the unfiltered truth, because this story is global, and it will touch every wallet, every pension, and every future. Money looks like math. We see numbers on screens, coins in jars, balances that climb or fall. But money is psychology first, and power second. Empires rise when money is trusted. They fall when trust is weaponized. The primary mechanism behind every collapse is deceptively simple and devastatingly effective. The debt monetization loop, the engineered cycle where governments, with central banks as partners, create money to buy debt, mask insolvency, and concentrate wealth. The big reveal: when an empire learns to create its own money at scale, it also learns to weaponize that creation. And the result is not random collapse, but a designed redistribution of wealth and power. In short, empires don't always fall by accident. They often fall by design. Think of Rome. The silver denarius was once a symbol of Roman power, pure metal, broad trust. Over the centuries, emperors shaved silver content, diluted coins, and paid soldiers and bureaucrats with lighter currency. Prices rose. Taxes were demanded in greater quantities. Provincial farmers and city merchants found their savings worth less every season. Sound familiar? In the 3rd century, economic strain fed political violence, and the imperial order fractured. The currency did not merely lose value, it changed the incentives of the elite, who shifted from commerce to extraction. Sound familiar? Fast forward to 1923, Weimar Germany. Printed marks until bread cost billions of notes, and children burned stacks to keep warm. The money didn't just vanish, it reallocated wealth from the broad middle to those who debought real assets before the wheelbarrows arrived. Sound familiar? These are not isolated stories. They are iterations of the same blueprint. By the 20th century, printing money became a policy tool rather than a last resort. Central banks emerged as guardians of stability. The Fed, in 1913, the Bank of England, centuries earlier, and with them came the modern temptation. If money can be created digitally, why not use it to smooth crises, finance wars, subsidize industries, and placate voters? The answer came with consequences. Nixon's 1971 decision to close the gold window severed the dollar from metal and tied value to faith alone. That faith can be manipulated. In 2008, the response to a liquidity crisis was not austerity but an avalanche of new money. The US Treasury and the Federal Reserve rescued banks with $700 billion in initial bailouts and then fed markets with trillions more. In 2020, with the pandemic shock, central banks and treasuries printed and injected another multi-trillion wave. The Fed's balance sheet expanded by over $4 trillion in months. These tools are framed as emergency medicine, but used repeatedly they become instruments of systematic redistribution. The twist in modern times is speed and opacity. Ancient Rome debased coinage over decades. Weimar's hyperinflation unfolded in months. Today's system accelerates. Digital ledgers, high-frequency trading, and global capital flows can move the equivalent of centuries' worth of value in minutes. The debt monetization loop operates like this. The government runs a deficit. It issues debt. Private banks and investors buy that debt. The central bank steps in officially to provide liquidity, buying that debt with newly created money. Banks and insiders with early access to freshly minted liquidity buy assets. Asset prices rise. Ordinary citizens and savers watch purchasing power erode. The debt hasn't vanished, it's been monetized, but the cost is hidden as inflation and asset price inflation. You want to believe the name of the off-ramp many modern elites use to repackage this as progress. It's called quantitative easing, but the receipt is wilder than you think. When we speak of empires falling, we often imagine armies and invasions. The more subtle collapse is fiscal and social. Excess liquidity masks structural weakness. It fuels bubbles in housing, stocks, commodities, and creates winners and losers before the reckoning. The winners are nearly always those with privileged access to credit and new money. Big banks, private equity, hedge funds, and politically connected actors. The losers are retirees, Wage earners, small businesses, and pension funds, everyone on the wrong side of timing. Money printing is a hidden tax. It dilutes each citizen's claim to real goods and services. That dilution is silent, cumulative, and ruthlessly efficient. Let's put numbers on the table so the pattern is undeniable. In 1971, the tether to gold broke. In 2008, $700 billion in bailouts set a precedent. In 2020, central banks added more than $4 trillion in liquidity in short order. Today, global debt sits north of $315 trillion, more than 3 times global GDP. The notional value of global derivatives estimates hover around $1.2 quadrillion, numbers so large they never appear in headlines because they are terms of private contracts, opaque and interconnected. When debt is this vast and leverage this extreme, printing becomes the only tool left to prevent immediate, visible insolvency. But printing is not neutral. It concentrates power. Individuals who understand the timing, insiders convert cheap, newly issued money into hard assets or political favors. Over time, the empire's middle erodes and the social fabric tears. Look at the mechanics again. Quantitative easing is presented as market-saving liquidity, but it functions like a staged transfer. The central bank buys government bonds. Those bonds are initially held by primary dealers, big banks. When the Fed purchases them, it credits the dealers' reserve accounts with new money. The dealers then deploy that liquidity into markets, equities, real estate, corporate buyouts. Asset prices rise. The public's nominal wealth may rise to stocks and houses, but real purchasing power and wage growth lag. This divergence widens inequality, and because the central bank's balance sheet is now packed with government debt, the relationship between sovereign finances and monetary policy becomes a loop rather than a separation of roles. The government borrows, the central bank monetizes. The cycle repeats. It is elegant for policymakers, but parasitic for the rest. Empires that have relied on printed money have also weaponized the narrative of necessity. The rhetoric is always the same. We must act to prevent catastrophe, to save jobs, to stabilize markets. That rhetoric has moral force. Who wants to be the one to starve citizens in a crisis? Yet each intervention reduces the incentive for fiscal prudence. When deficits can be financed implicitly by central bank balance sheet expansion, political actors have less reason to make hard choices. The next election becomes an event financed by future money, and generations pay the bill through inflation and weakened institutions. Over time, the fiscal and political class merges. You can see it in empires past. The fiscal apparatus becomes the regime's lifeline, and once the printing press becomes routine, trust becomes conditional rather than universal. Citizens obey, but not for loyalty. They obey because their survival depends on a system that can be shut down or reprogrammed. Another layer is monetary illusions, ability to fund empire expansion without immediate accountability. Spain in the 16th century used New World silver to finance endless wars and palace building. The state appeared wealthy, but real productivity stagnated. The short-term gains from resource inflows funded elites while the economy's foundations decayed. The analogy to modern printing is striking. Newly created money funds grant projects, bailouts, and subsidies, but divert resources away from productive investment into rent-seeking activities. Productivity falters. Growth becomes an illusion propped up by liquidity. Eventually, the credit lines dry, or the inflation expectation becomes self-fulfilling, and the system collapses under the weight of its own promises. Sound familiar? The 1920s and 30s showed us that when monetary confidence collapses, social cohesion frays, hyperinflation breeds desperation, and desperation breeds extremism. The Weimar experience is not an outlier, it's a warning. Democracies can erode into authoritarianism under the strain of monetary collapse because coercion appears as the only solution to extract resources and maintain order. Rome's late empire moved toward militarized taxation and extractive governance. We see echoes today in the increasing use of emergency fiscal powers, surveillance tools, and capital controls under the guise of stability. Sound familiar? When trust in money declines, civil liberties are first to be compromised in the name of economic salvation. Sound familiar? The modern accelerant is technology. Digital money, central bank digital currencies, CBDCs, and programmable ledgers can be a force for efficiency or a tool for control. When money is programmable, authorities can set expiration dates, behavioral incentives, and restrictions at will. Imagine a currency that rewards certain purchases and penalizes others, or a digital wallet that restricts transactions based on political signals. The death of empires 2.0 is not only economic, but informational. To control money is to control behavior. In the hands of benevolent guardians, that's optimization. In the hands of extractive elites, it's social engineering. And history shows too that power tends to attract the extractive. What would a collapse look like under the modern blueprint? First, a shock, perhaps a sovereign debt panic, cyber-attack, or a geopolitical disruption that severs confidence. Markets convulse. The government responds with emergency issuance, and the central bank expands its balance sheet further. The immediate panic recedes, but the long-term effect is an entrenched monetization. Debt bought and held on central bank balance sheets, private credit markets distorted, and a new normal of inflated asset prices. Next, political actors exploit the moment. Controls on capital, directed credit, and regulatory favors that entrench winners. Real wages stagnate. Social services are prioritized. The wealthy and the connected have portfolio insurance. The rest have only narratives of recovery. Over time, the public recognizes the transfer and grows resentful. But by then, the institutions are weaker and capture is deeper. The state survives, but the social contract has been mortgaged. There are 5 brutal numbers to remember in this blueprint. 1971, the year the $S gold link ended. 1923, the Weimar year of hyperinflation that turned lives into ashes. $700 billion, the initial 2008 bailout figure that recalibrated expectations. $4 trillion, the Fed's rapid balance sheet expansion in 2020, and $315 trillion, today's approximate global debt. These figures are not trivia. They are the coordinates of the collapse map. When policymakers treat them as tools rather than constraints, the decline accelerates. So what can be done? History suggests only 2 real defenses: discipline and diversification. Discipline means restoring fiscal responsibility before the gap between promises and production becomes unbridgeable. It means limiting the automatic resort to monetization and reinforcing independent monetary mandates. Diversification means citizens and institutions must hold some assets outside of the politically manipulable money system. Tangible goods, diversified foreign assets, or assets that are difficult to export. But political actors rarely favor restraint that reduces their immediate scope. That's why the collapse blueprint persists. The incentives of those in power are misaligned with long-term societal stability. The lesson is simple and disturbing. Printing to solve problems creates larger problems not later, but now. The act of monetization crystallizes power into forms that are difficult to dislodge. Empires do not always fall because enemies conquer them. They often fall because they have already hollowed themselves out from the center, turning money, the glue of civilization, into a wedge. The history of Rome, Spain, Weimar, Germany, and modern bailouts is not a series of unrelated tragedies. It's a pattern, repeated and refined, and the tools are getting faster and more precise. Are we wiser now, or simply walking the same path in better suits? If you believe in foresight, then act. Comment where you're watching from, share this video, and subscribe for more investigations into the invisible forces that shape our world. The blueprint for collapse is not a mystery once you know where to look. Understanding it is the first step toward resisting it. When empires print beyond their productive means, they do not simply expire. They engineer a slow redistribution that leaves the few intact and the many impoverished. That is the collapse blueprint. Know it, question it, and refuse to be collateral in someone else's ledger.